You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The post-pandemic Treasury market will be shaped in part by the term premium, how much investors demand to hold longer-term securities over short-term debt. The term premium has fluctuated over the last 40 years with changes in inflation risk, federal deficits, central bank balance sheets, and the profile of Treasury buyers. And although it is not directly observable, statistical estimates like the Adrian, Crump, and Mönch model from the New York Fed illustrate how the term premium shifts depending on the macroeconomic landscape. On today's episode, we talk with Emanuel Mönch, professor of financial and monetary economics at the Frankfurt School of Finance and Management, about how to estimate the 10-year Treasury term premium, why it helps us better understand the bond market, and how he thinks it will change under a Kevin Warsh-led Fed. Stay tuned. Coming up soon, our interview with Emanuel Mönch, but first, a quick market update. Treasuries rallied and crude oil prices sank last week following a report from Axios that the U.S. had submitted a one-page peace proposal to Iran. Iran eventually rejected the proposal and countered with its own conditions, which the U.S. did not accept. The all-too-familiar breakdown of negotiations gradually pushed bond yields and energy prices back up. As of recording, the 10-year Treasury yield is 4.40%, and most benchmark tenors have broken through recent support levels. The Strait of Hormuz is still effectively closed, and front-month WTI crude is trading above $100. The April CPI rose 0.6% this week, as expected, while the core CPI rose 0.4%. Higher energy prices unsurprisingly pushed up the headline index, while the pop in core inflation reflected a statistical quirk tied to how the BLS measures shelter prices. Excluding these elements, underlying inflation was elevated last month, but not getting any worse. More importantly, prevailing inflation fears stem from the risk that rising energy costs get passed through to broader consumer prices and cause inflation expectations to become unanchored, a process that would emerge in the coming months rather than in April. To this point, the 1.5% increase in the April PPI this week is more concerning. The magnitude and duration of the war's energy price spike will be too much for firms to absorb purely through lower profit margins, so hot producer price inflation is a very real risk to future consumer inflation. Last week, the April jobs report showed payrolls grew a solid 115,000 and the unemployment rate was unchanged at 4.3%. As the Fed waits to see how the war affects underlying inflation, officials can feel confident, for now, that the labor market is not in dire need of policy support, nor is it so strong that it is contributing to inflation. Treasury announced it would leave its coupon auction sizes unchanged over the next 3 months, as expected. The announcement also left in language saying they expected this to be the case for at least the next several quarters. Investors are expecting coupon Treasury supply to increase at some point, but this guidance likely postpones any upsizing until at least the second quarter of 2027. The Senate approved Kevin Warsh to be the next Fed chair this week, succeeding Jerome Powell when his term ends on May 15th. Warsh replaces Stephen Miron as a governor and is set to preside over his first meeting as chair on June 16th. That's all for the market update this time. Now our interview with Emanuel Mönch. Our guest today is Emanuel Mönch, professor of financial and monetary economics at the Frankfurt School of Finance and Management, and co-author of the New York Fed's Adrian, Crump, and Mönch model that estimates the 10-year Treasury term premium. Professor Mönch, thanks for coming on the podcast.
Thanks for having me, Will.
Our topic today is the term premium, how to understand its role in Treasury market pricing and where it may be heading in the next few years. To start things off, what exactly is the term premium when we're talking about the Treasury market or the bond market? Is it any different than when people use the term risk premium?
Not exactly. It's a specific type of risk premium. The term premium is the compensation that investors expect for holding longer-term government bonds, so a specific type of risk asset rather than short-term bills. It's really a special type of the risk premium, the premium investors require for bearing interest rate or duration risk, if you will.
And how is it estimated? So the 10-year Treasury today is between 435 and 440, depending on when you last looked. How do we look at that nominal yield and know what part of that is short-term interest rate expectations and what part of that is the term premium?
There's different ways of doing this. Typically, we use models, statistical or econometric models to estimate the term premium. It cannot be directly observed. They use a set of government bonds, decompose them into, or the yields into some smaller number of factors, make some assumptions about how the short rate evolves, the policy rate that the central bank sets, make some assumptions about how prices of risk evolve, assume the absence of arbitrage opportunities. That's typically a building block of these statistical models. And then these models allow you to back out the term premium essentially as the difference between the observed or model implied yield and then the model implied path of average future short rate. So what the model tells you the market would expect the short rate to evolve. And so the term premium is really the difference between the yield and then this expectation of future short rates, which we often retrieve from models. There's an alternative approach, though, which is to use observable measures of short rate expectations, which we sometimes can glean from surveys, for example, surveys of market participants or surveys of professional forecasters. They sometimes give you information about what market participants expect the short rate to evolve like over the next, say, 5 years. And then you can just use that expectation, the average short rate over the next 5 years, say, and you subtract it from the 5-year Treasury yield, and then you have a survey-based measure of the term premium.
And so those two different estimates or two different approaches, they generally move in the same direction, even if on a given day they're separated by a few basis points, right? They usually come to more or less the same conclusion.
Typically, because we don't observe these survey-based estimates at high frequencies, we can't really say. They move together at the daily frequency. So at lower frequencies, say monthly or quarterly, they tend to co-move, but they sometimes also give you different signals.
So this concept makes some sense in the abstract, but I want to go through a few time periods to drill down exactly what is going on during changes in the term premium. So to start off, using the New York Fed's estimate, what caused the term premium to decline from about 500 basis points in the mid 80s, according to the model, to close to zero in 2006? Why were investors becoming gradually more comfortable with less of a premium on top of their Fed policy expectations over that time?
Now, our model is a statistical model which cannot directly speak to that question, but of course we can use the model implied term premium and correlate it with observables. And the literature has pointed to several drivers of the reduction, compression of term premiums over that period. Inflation uncertainty, for example, is a prominent explanation. So since the early 1980s, when inflation was really high, inflation uncertainty gradually came down. You know, in the US, the Volcker disinflation period. Monetary policy, as a result, became more predictable. So short rates weren't as volatile as they used to be. And so the uncertainty about the future path of policy rates, which is a key driver of the term premium, came down. And so with this, long-term bonds became less risky investments. And so the term premium declined. There was also other factors that probably played some role. You know, from the mid-90s to about the mid-2000s, we saw a period of budgetary consolidation in the United States, so there was less issuance compared to previous periods, relative to GDP, of course. And then also the literature has often discussed the savings glut hypothesis, which is essentially the view prominently formulated by Ben Bernanke when he was a Fed governor, with developing economies becoming richer, but their financial markets not being as deep and as developed, catching up with that growth of income. A lot of money was flowing into the US from other countries. And oftentimes this money flows into relatively safe US assets, such as US Treasuries. So essentially pushing up Treasury prices, pushing down the yield, and hence making sort of US Treasuries somewhat less risky investments. And so those, I think, are the most prominent reasons. There are probably a few more.
That narrative of the so-called great moderation makes a lot of sense to me, but I want to go back to decomposing nominal treasury yields as short-term rate expectations and then a term premium. because within those two things, inflation or Treasury coupon supply doesn't really factor into either of them, at least directly. So if monetary policy is stimulative, of course, that might increase inflation or Fed tightening. And if inflation is high, the Fed might also tighten. But how do you draw a straight line between things like the deficit or inflation risk to the term premium?
You can't really draw a straight line, and at least not in these statistical models. You would have to have what we call a structural economic model, where you really model price setting in the economy. You model a central bank that, say, follows a specific policy rule, like a Taylor rule. You have to maybe model a government that follows some budgetary rule issues, etc. In such a structural model where you have basically a general equilibrium view of the economy, you can think more structurally about the term premium. But those models often find it difficult to match asset prices closely. So what we often then do as economists is we write down models that explain asset prices well, meaningful in certain dimensions. For example, they assume that there's no systematic arbitrage opportunities. And then we back out this estimate of the term premium, then related ex post to other observables. There's research showing that measures of the term premium correlate with, say, measures of debt supply. They do correlate with disagreement about future inflation or uncertainty about future inflation. And so it's more sort of ex post that we can establish these correlations when we talk about what is driving the term premium. We have a good sense from these structural models, but we can't really use them one-to-one because they often have a difficult time matching asset prices at high frequencies.
I want to go back then to the period after the financial crisis. So the term premium went up to about 350 basis points in 2008, and then gradually declined again in the following years, even going negative. So what does it even mean for the term premium to be negative, and why did this happen?
I think there's several factors. The most important one is probably that the Fed bought a lot of treasuries, and other central banks around the world at the same time were buying their country's sovereign debt. So there was overall a compression of term premiums around the world. It's not just the Fed, but with these central banks purchasing a lot of longer-term nominal bonds, they were pushing up the prices of these bonds. And so the expected return on these bonds, which is what the term premium essentially represent, would decline. And so that, I think, is the main reason why the term premium has gone negative. What does a negative term premium mean? It means that basically you, as an investor in a long-term treasury bond, you expect a lower return than essentially rolling over shorter term bills. And again, if central banks predominantly purchase longer term bonds, that's maybe what you expect to see. I don't think it's nonsensical to have a negative term premium, to think about it in this way. Another way to think about the term premium is as basically how correlated are the payoffs of nominal bonds with what we call the pricing kernel or stochastic discount factor, the marginal sort of willingness to take risk by households or investors. And if an asset pays off in bad times, then it's an investment that investors often like and are willing to even pay a premium for. Think of it like an insurance policy. You buy insurance because it pays off in really bad times. And some assets have such features. They pay off, especially in bad times. Now, if nominal bonds, when do they pay off? Well, when inflation is falling. If this is a bad time, then these nominal term premiums can also be negative from this point of view. So it's not just about the Fed or other central banks purchasing a lot of longer-term treasuries. I think that's the main reason. But it's also, when do nominal bonds have good payoffs relative to, say, other assets? And is this in particular true in good or bad times? And so that's another way to view the term premium. And a negative term premium would be justified if the treasuries are an asset that pay off, especially in bad times.
I want to try to rephrase this and let me know if this is an accurate way to think about it. So the market, has this idea of where short-term funding rates are going to be on average over the next 10 years. And when there's a positive term premium, that means, okay, if anything, rates are going to be higher than that. And so we need this premium. But when there is a negative term premium, what is kind of being communicated there is, all right, we have this baseline expectation for what policy is going to be over the next 10 years. But if anything, the risk is probably to the downside, so we're willing to lock in the 10-year at kind of a lower rate.
Yeah, I think that's a fair way to also say the same thing. I like that way of saying it.
Great. I'm happy to take credit for that. Now, obviously, an essential question for bond investors and many of the people in our podcast audience is what the post-pandemic bond market is going to look like. The decade before the pandemic was an outlier in so many ways, but even if we don't return to that, the question is what becomes the new normal? Now, through the last 6 years of these relentless macroeconomic shocks, the term premium stayed negative and even now is only 80 basis points. Why has it been so low the last few years, despite what many would consider to be pretty elevated uncertainty for interest rates and the macroeconomy? So here we are, it's about 2 months into the war in Iran, and no one really knows how it's going to evolve, how it's going to end, what the impact is going to be on inflation or oil prices. But 80 basis points, historically speaking, is really not that big.
That's true. You could be surprised about that, but remember, if the term premium compression that we saw into negative territory was really happening to a large extent because central banks around the world purchased a lot of sovereign debt, including the Fed. I mean, the Fed's balance sheet is still more than $6.5 trillion US dollars. They started QT and they wound down the balance sheet a little bit, but right now they're actually purchasing T-bills again. And so I think having this really deep-pocketed investor out there, having a strong footprint in the Treasury market is probably the dominant reason why term premiums haven't increased back more than what we've seen. And so as long as the balance sheet is large and as long as the balance sheet is mainly composed of longer term treasuries, then I think we'll see a term premium that's relatively moderate compared to maybe the 80s or 90s we discussed earlier.
Big balance sheets from central banks, you've made it really clear how that can depress the term premium. And one way that I think about it is that central banks are pretty insensitive to price and interest rate risk. They're going to buy and hold until those securities mature and they can effectively print money out of thin air. And I imagine that sensitivity to interest rate risk or duration risk is really different even among private sector treasury buyers. So do you think that there will be changes in the coming years? Any idea of the profile of treasury investors that you think will affect the term premium? Whether it's life insurance companies, community banks, hedge funds, they all must have different sensitivity to these risks that also mean different term premium.
That's true. So if the composition of treasury investors somehow were to shift substantially, then you would expect to see that having an effect on the term premium. Now, I don't see structural shifts in the economy that make me think that, say, pension funds or insurance companies that typically want to hold these longer term securities to basically balance the duration of the asset and liability side of the balance sheet. I don't see these changing their investment behavior dramatically. I also don't see this on the part of money market funds, which predominantly want to hold, have to hold shorter term bills. What you might see coming up is that because of geopolitical disruptions, maybe fewer international investors, especially fewer foreign central banks, pile into US treasuries as a big chunk of their reserves. So maybe there are some movements out of treasuries on the part of foreign central banks, which are a big holder of treasuries. And you may also see now with Kevin Warsh becoming Fed chair, you may also see a little bit of a recalibration of the Fed's balance sheet. He's said repeatedly that he wants to shrink the balance sheet. He also wants to coordinate one way or the other with the Treasury. It's a bit difficult for me to predict exactly how this is going to look like, but he has repeatedly said that he wants to shrink the Fed's balance sheet. If that was the case, then there would be less of a demand for treasuries from that deep-pocketed market player, and that would likely also result in an increase of the term premium.
Another thing that Kevin Warsh has really made a big point of is not only the smaller balance sheet, but also he is coming in with this idea that he thinks the Fed communicates too much, that they're overusing forward guidance out of emergency situations. And could that end up having impacts on the term premium? Because if we're thinking about what is the risk versus some baseline expectation of Fed policy, well, suddenly the removal of forward guidance, for better or for worse, makes that baseline a lot cloudier.
I would agree. I think there's reasons to believe that if the Fed were to really communicate much less about the future path, and if that contributed to a higher volatility of short rate expectations, then you should see some increase of the term premium as a result of that. Now, sometimes maybe the Fed communicated too much and contributed to volatility of short rate expectations. It's difficult to say. It depends a little bit on how it's done. But clearly, if you communicate a lot and keep saying different things, you increase volatility of short rate expectations, and that might result in an increase of the term premium. But that's probably not what we'll see. I think the Fed, if they really communicate substantially less, then I think we will ultimately see that the term premium will slightly increase as a result, because rate expectations will become more volatile. I think forward guidance, for the most part, has worked well in stabilizing short rate expectations. And during the zero lower bound period, when the Fed was also engaging in forward guidance, we saw that the term premium was really compressed. And I think that's really the sum of two things: the purchases that we already discussed of longer term treasuries as part of the QE programs, but also the forward guidance limiting the volatility of short rate expectations.
Is this a helpful concept, the term premium? I mean, sometimes I do listen to some arguments from both sides about whether it is this catch-all residual that really doesn't tell us too much we don't already know. So do you think that looking at how the term premium has moved throughout time, where it is today, does it help us understand the bond market? Does it give us any information we don't already know?
I think so. I mean, it's really helping us to think of longer term sovereign debt as a risky asset. You know, there's some risks embedded, just like we think of the equity risk premium as a good measure for how fairly valued the equity market is. I think the term premium is a good measure of how longer term US or Treasury debt is valued. And so it's a useful concept. You don't want to focus too much on the given level of the term premium at any given point in time. I think because of estimation uncertainty, I told you the many assumptions that go into these models, there is clearly a range of plausible values for the term premium. I wouldn't just focus on one particular estimate. But if you see secular shifts in term premium estimates, maybe coming out of different models or coming out of survey-based approaches and these models, as we discussed, then I think it gives you a good indication of where the Treasury market is headed and how Treasury market investors perceive the riskiness of longer-term Treasury bonds.
All of those structural changes we talked about with global savings or balance sheet approaches and maybe a lessening of forward guidance under a Warsh-led Fed, putting all of those things together, where would you say the term premium is going over the next few years? Do you expect it will go back above 100 basis points anytime soon? And I know this is like the baseline of the residual against the baseline. There's a lot of uncertainty here, but what do you think? What does the new normal look like for the term premium?
I would think that the term premium will increase in the next few years, given what we discussed about the likely path forward with the Fed's balance sheet, the issuance that we will likely see of new Treasury debt also going forward. I think there's many reasons. The inflation volatility that we probably will see because of geopolitical and other disruptions. All of these, I think, tend to push the term premium up. Foreign investors may be moving out of treasuries little by little. So if anything, I think there's more upside risk for the term premium going forward. I wouldn't want to speculate about the exact level. Again, you don't want to interpret too much the point estimates, but clearly I would expect it to go up over the next couple of years.
Professor Mönch, thanks for coming on the podcast.
Thanks so much for having me. It was a pleasure.
That was Emanuel Mönch, professor of financial and monetary economics at the Frankfurt School of Finance and Management. As investors think about what the new normal might look like for the post-pandemic Treasury market, I think Professor Mönch's projection for a slightly higher term premium is spot on. Inflation risk is higher than the decade before the pandemic, federal deficit worries are elevated, and the Fed is going to use less forward guidance outside emergency situations during Kevin Warsh's tenure, all of which are factors that drive the term premium higher. Still, inflation risk is not so high that we'll go back to the 300 basis point term premium we saw in the 1990s. Developments in the Middle East will continue to drive the Treasury market for the foreseeable future. As of recording, the US and Iran are in a fragile ceasefire that is limiting further escalation in the war, but keeping the Strait of Hormuz effectively shut. Both countries face rising pressure to resolve the conflict, even if not immediately. The Washington Post reported that a CIA analysis estimates the Iranian regime can weather a blockade of its oil exports for 3 to 4 months before experiencing significant economic harm. In the US, high fuel prices are a political risk for incumbents facing re-election this November. The Fed will release the minutes from its April meeting next Wednesday. The 4 formal dissenters have already clarified their thinking in public communication since the meeting, but investors will be looking at the minutes to see how the broader FOMC chose to maintain language in its policy statement that suggested an easing bias. The next move in rates will depend on how the data evolve, though the minutes could shed light on the Fed's reaction function to higher energy prices. The following week, the BEA will publish the April PCE on May 28th. As with the CPI, the PCE deflator is expected to show food and energy prices boosted the headline measure, but that it's too early to gauge how the war in Iran has affected core inflation. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.